Welcome back, everyone. Today on the Joseph Carlson Show, investors are still trying to figure out what to do. All of us wake up every morning trying to check the news, seeing what's going to happen today. There's a lot of uncertainty, a lot of unpredictability. The market doesn't like this, and that's why the stock market is down around 10%. We're now into correction territory. We're seeing a bit of a bounce back today, but it doesn't feel like the trouble is over. And we're going through what a lot of people a lot of commentators are saying is now a bit of an adjustment. We're going through an adjustment period. In today's episode, we're going to try to make sense of it all, try to get to the bottom of this news revolving tariffs and policy and uncertainty and how this works its way into the investment world. What should investors be doing right now when looking at the crazy, unpredictable world we face? And we have a lot of news to get into. Inflation eased more than expected. The numbers came in below analyst and Wall Street's expectations. That was good news that inflation is coming down, but concerns about tariffs and the impact on inflation still persist. We also have a long-form interview with Brad Gerstner. Brad Gerstner is one of the super investors that we follow in our 13F filings. He runs the fund Altimeter, and they invest in a lot of technology companies, very similar to the type of companies we invest in here. So we're going to be looking at that long-form interview. I'll be reacting to it. He goes into a lot of different subjects, one of which is the uncertainty around the president's messaging with tariffs. So we'll be looking at that as well. We're also going to be looking at a recent interview with Tom Lee. He goes on to CNBC and gives his predictions of why he believes the market today is in the bottoming phase. So we'll be looking at his argument as well. We also have Mark Benioff from Salesforce, now saying that cloud companies like Google, Amazon, Microsoft, Azure, they're all commodities. And Salesforce is not a commodity, being a software company. We'll be going into what's true about that statement and what's false about it. We also have Ray Dalio finally saying again that he's warning about disaster. And this is something that Ray Dalio has done a time or two, or three, or four, or five, or six, or seven times. In fact, he's given the same type of warnings dozens of times. We'll be going over the long history of Ray Dalio and why he wants economic disaster to happen. He's not just predicting it, he needs it to happen. He wants it to happen. Ray Dalio is looking forward to the next economic disaster. So we have a lot to get to in this episode. Let's go ahead and jump in. Now, we start off today with the news that inflation numbers came in. They were reported for last month and they rose less than expected, which of course is welcome news. Prices for goods and services moved up less than expected in February, providing some relief as consumers and businesses worry about the looming impact tariffs might have on inflation. Now, if the inflation number came in for February and it was higher than expected, you know what the headlines would be. It'd be that tariffs are already causing inflation. Even just the beginning of them they're causing inflation. So this gives a little bit of relief. We don't have inflation in the numbers as of February. Excluding food and energy prices, the core CPI rose 0.2% on the month and was 3.1% on a 12-month basis, the lowest reading since April of 2021. They say that the economists surveyed from the Dow Jones have been looking for 0.3% increases on both headline and core, with respective annual rates of 2.9 and 3.2, meaning that all of the rates were 0.1 percentage points less than expected. So even though this is welcomed news that in February inflation didn't go up, we are going to look at March and April and May and what's going to happen in the future. And investors are still concerned about that. The vagaries of uncertainties associated with the policy are still much stronger force in the market than anything CPI related or in terms of the data points. Investors see this as a nice little sideline piece of news, a positive development amongst a lot of uncertainty, but the same central focus remains, which is tariffs. Investors are overwhelmingly concerned about tariffs, the policy going forward, and the lack of predictability. And one investor that I like to get his perspective on, because he has a very similar thought process and portfolio full of high growth tech companies, similar to my investing strategy, is Brad Gerstner. He runs the fund Altimeter, and he came on to CNBC to explain his thoughts on all this uncertainty and how he's factoring that into his portfolio. So let's take a look at what his thoughts are, and I'll highlight what I think are some of the most interesting points.
You know, we started the year markets at an all-time high. We had seen a big Trump bump coming out of the November election. And when you listen just to the words of the president, we knew this was going to be a big period of transition. Right? We were going from a period of 4 years of $2 trillion deficits, massive fiscal stimulus, massive monetary stimulus, and we're going to delever the economy, right? He talked very openly about the tariffs, right, more reciprocity, fairer trade, talked openly about the fact we're going to have some level of austerity with Doge, et cetera, that we'll get into today. periods of uncertainty. We have high economic uncertainty, high political uncertainty, and high technological uncertainty.
And high multiples.
Right, at all-time high multiples. So there's only one thing that can happen. Discount rates have to go up. Right? Risk premiums have to go up. And when they do, multiples come down. So for us, that was just a period to say, okay, we'll go to the sidelines. We'll wait this out a little bit. We've seen the markets come back in. And I have to tell you, we were buying some yesterday because now you see NVIDIA at 18 or 19 times next year's earnings. Now you're getting paid. Well, you have a margin of safety.
The question. Now, he first starts off by giving some background and explaining the context of higher multiples and a period of uncertainty. Now, a lot of people try to say that buying companies at attractive price points is market timing, and that's not the case. If you sell stocks when multiples are very high, future expected returns are low, where you're getting a lot for your money, a lot for your shares, and you buy different companies at lower multiples, lower expectations, but still great growth prospects, that's not market timing, that's just value investing. Now, as he goes on here, he accurately describes the uncertainty happening in the market today.
The market now is firmly ensconced in understanding that we're in a period of uncertainty. So I think about the first 10% down, Andrew, which I think the NASDAQ troughed it down 14% yesterday from its peak, okay? The first 10% is just digesting the fact that there is more uncertainty. This week was the first week where I saw a banner on CNBC that says fears of recession. Mm-hmm. So the second 10% really is about growth and recession.
And where are you on that score?
So I think the handoff between these two policies, right, can be messy, and it could tip us in to growth concerns or recession. We heard Delta warn earlier this week. We heard cautionary comments out of Walmart. So I don't think we can, go slowly through this transition. I think the economy is fundamentally sound, but I think we need to get clarity around the tariffs. We need to get clarity around taxes. We need to get clarity around reconciliation and DOGE. I think the president's going to lead us in that direction.
Notice what every investor wants. Every investor wants a nice forecast of the future, of what will likely happen, what to expect, what actions are going to be taken. For investors, the unknown, uncertainty is the worst thing. It's the last thing that investors want.
What you would think is, wow, this is dirt cheap? 20%, 25%? From
off the peak?
Off the peak.
Oh, well, again, it's all fact and circumstance dependent.
This is a perfect question for him because this is the same type of question I get all the time. In a lot of cases, people are asking, is this the bottom? Are you going to be able to buy the bottom right here and it will go back up after you buy?
Right. I think we're heading in a pro-growth, lower regulation, fiscally more responsible direction.
On the other side of this.
Right. And so when you're off 20%, to me, that's probably a huge buying opportunity. Because remember this, Joe. As of yesterday, the average stock in the Russell 3000 was down 30%. Yep. The average stock. Most stocks in the NASDAQ I was looking at were down 20 to 40%. So yes, the index was only down 14 because of the Mag 7's weight in the index.
So timing is a dangerous game, but the question is, to the extent you think this continues to be messy, how messy is it? How much more is there? And to the extent there's some people who are sitting around going, you know what, the knife is falling, I'm going to... So timing is a dangerous game.
They continue to ask him to time the market. And it is the question on every investor's mind. We want to buy the dip, but we don't know what the dip actually is. Is this the dip or is the market going to fall another 20%? I might run out of money if I buy it today. So should I wait for next month? Should I wait a week? What should I be doing in this situation?
The future is a distribution of unknown probability. So there, of course, is a probability, right? There's a certain distribution that we're going to go further down. And let me give you some scenarios, maybe a framework to guide how we're thinking. So first, the president has said April 2nd is going to be a big day. Howard Lutnick has come on here and said April 2nd is going to be a big day. We're going to announce the reciprocity tariffs. So I think we have to wait and see. We have to wait and see what that is. Now, the question is that the start, Andrew, or the end? Right? If that's just saying, we think the Europeans have $2 trillion of non-tariff trade barriers against the United States, and we're going to impose very high tariffs against the Europeans, then it's more like a start than an end.
And the Europeans are already making noise this morning to say that there would be reciprocal tariffs to our reciprocal tariffs.
Correct.
If that's what.
So I think, listen, on the tariffs issue itself, if you believe that we're heading in the direction, I see Peter Navarro come on here sometimes, I think he's great. But if you think we're heading in the direction of high structural, permanent McKinley-style tariffs, then we have further to go down. There's not a lot of support on capital.
What do you think?
Right? So I don't. I fundamentally think that, the president is negotiator in chief. He likes to keep all of us off balance. He likes to keep all of his negotiating counterparties off balance. I think it's probably a pretty effective negotiating technique. In order to do so, he has to make you believe that he might actually impose super high protectionist structural tariffs. But at his core, I think he's a free trader. At his core, I think he wants to make deals.
He's exactly right that if the United States takes the approach of implementing high structural tariffs, meaning that there are these very steep tariffs that are there forever, not used as part of a negotiating tactic or to bring people to the table, but just there to collect external revenue and replace the income tax, that's going to cause markets to go down. Why will that cause markets to go down? Because it's different. It's a lot different than what we're doing right now. Having a dramatic change in the way that the US government generates tax revenue, going from income tax to tariff revenue, will cause the markets to go down because it generates a lot of uncertainty. We haven't done this before. It's new to all these investors. And if we're dramatically changing the way that this works, it's going to cause discount rates to go up, uncertainty to go up, and that will be priced into stocks. Not to mention all the friction it causes around the world with different trade partners that also creates another level of uncertainty. But as he says here, he doesn't believe that's the game that Trump is playing and ultimately where this is headed. He believes it's a negotiating tactic. And the pretext to convincing other nations to come to the negotiating table is Trump has to pretend like he's willing to do this forever. If he said it was only a temporary thing, then other nations would know that they can simply wait it out. And other nations likewise are pretending like they can implement their high tariffs forever. We see other countries doing the same thing, like Canada. Europe is going to be doing the same thing. In reality, most of us can't afford to do this forever. So I think that, again, Brad Gerstner is correct in saying there's a lot of flustering and bluffing going on today that's being used as a negotiating tactic.
My sense is that you got to take it as it comes. Price, the market's going to adjust along the way. But if you think there's a clearing event thus far, I don't see any clearing event, right? We're still in the land of the ambiguous. Every day, everybody's waking up in the morning to see what was said overnight. I think April 2nd will provide a little bit more clarity. I'm hopeful that May will give us what we need. I hope that's the clearing event. I hope we know at that point in time what reconciliation
April showers bring May flowers.
Exactly. But listen, the fact that everybody is operating on that framework probably tells me that's not how it's going to work, Joe.
So right now, there's already some of this uncertainty and ambiguity priced into the market. We're down 10% from our highs. So this is investors' way of saying, we're uncertain about the future, we're going to take prices down until things clear up a bit. Now, whether we go up or down from here, he says, is dependent on economic outcomes, meaning that right now, what's currently priced into the market is tariffs and flustering about tariffs and reciprocal tariffs. The tariff news is already somewhat priced into the market. Having more and more tariff news every single day, it becomes a little bit more mundane. It's less exciting every subsequent day. Just like any other surprising news at first, when you see more and more of the same thing, it just loses its effect. It loses its impact. And you can see the tariff news doing that in the markets. Signs of new tariffs and plans of new tariffs are not really affecting the market like they used to. What would affect the market here from today is talk of recessions. If we see more economic data of slowing in businesses, of restaurants having less patrons, of different companies saying that they're having slowdowns towards the end of the month, like Walmart, if we see more and more of that every single month, and we see chatter of recessions, that's where the market could go down another 10%. Then we're down 20% from highs. Now, the next thing that they go over is Trump's change in tone from the first term to the second.
He is not getting up every morning watching CNBC and adjusting policy based upon whether the futures are up or down that morning. I know there is a conventional wisdom that that's the case. I think this president went through a life-changing moment in Butler, Pennsylvania. Yeah. And I think he wants this term to be of consequence. I think he has beliefs that go back 30 or 40 years.
Now, the question of whether or not Trump is looking at the market, I believe is pretty obvious. I think he's looking at the stock market. Now, he can ignore stock prices over a short-term time period. He can ignore them over a month or 2 months or even a couple quarters, 6-month stretch of period. But if the stock market tanks under Trump's leadership and we head into midterms, That'll be a very vocal talking point. It will impact politics, his ability to pass other policies. It'll impact his support. The stock market is not just tickers on a screen, it's people's wealth. It's people's wealth for their retirement. People that have supported him and voted for him are now looking at the stock market, and that's a big gauge of how they view success, how they view success of the American economy, how they view things are going in the presidency. So even though he can ignore it for a few months, I think that he is going to come back and be concerned about it. I think it's a priority under his leadership, and I don't think there's any way around it. Now, the next subject is on Doge and whether or not the United States actually has a chance at reducing spending of the government and balancing the budget, or at least getting closer to it. Right now, the budget is way out of balance. We're adding on $1 trillion of debt every 9 months, and Doge is one of the efforts trying to prevent that.
This president and his economic team, which is incredible, Kevin Hassett, Bessent, the Commerce Secretary Howard, he's got great advice around him, and they want to reduce the deficit during his term in office. Frankly, I think he said he would love to get to a balanced budget.
See how?
But I certainly think we'll get to 2% of GDP under his term. Here's how I think we get there. Most of the tax cuts are extensions, Joe. Yeah. But I agree with you. Tax on tips, I think that's $80 billion. Taxes on overtime. You're not going to be able to do all of them at the scope, perhaps, that people are estimating.
But I don't think the CBOE has the extensions.
The CBO.
Sorry. Not the Office of State. I don't think the CBO has those tax cuts as permanent in the numbers. That adds how much? That's why they did it in 2017.
Correct. They're going to scale these to 7 to 10 years. But by the way,
they will.
In 7 to 10 years, these things are going to expire, and they're going to have to be reauthorized. And you just heard Ray Dalio say, 7 to 8% debt to GDP is unsustainable. Everybody knows that.
We can get to 2?
I think we can get to 2%
with growth.
And here's how we get there. I've tweeted about this. You can see the chart. Elon retweeted this chart. If you just baseline 2019 federal spending, and in 2019, nobody on this set thought kids were starving in the streets or weren't being educated or we weren't spending enough as a federal government, right? We spent $4.5 trillion in 2019. Grow that at 3% a year. If you baseline that, we should be spending about $5.5 trillion this year. Instead, we spent $7 trillion last year. That is COVID stimulus. That is the Red Bull high that we all put ourselves on. So if you just went back to the 2019 baseline, you grew it to 2029, that's $6 trillion in spending, okay? I think we can get the federal revenues to $6 to $6.5 trillion by 2029 by just growing 2.5%. So I think there is a reasonable shot at getting close to balance at $6.5 trillion in 2029, but you're not going to get the entire wish list.
This is part of the adjustment of the market. We're going from a time period where just a couple of years ago, the entire economy was infused with trillions of dollars of cash. A lot of people quickly forget, but we had thousands of dollars directly deposited into checking accounts. Businesses received hundreds of thousands, millions of dollars, sometimes tens of millions of dollars, just to keep employees on payroll. And this money was launched into the economy in a very short span of time. Now, as we go through this transition period, we also have the comments from Tom Lee, who has a much more simplistic view on the matter. He simply believes that stocks are undervalued, that a bottoming is happening here, and he explains why.
Well, yesterday really was an indiscriminate selling day. Did Tesla's valuation and fundamentals drop 15%? Did the broad market have a 4% decline in valuations? To us, it really looked like a lot of liquidation. I think investors are, of course, reacting to the White House warning of pain ahead, but it has been more of an equity sell-off than it has been in corporate bonds. So to us, 4% down days, I think it's an overreaction.
I admire his attitude. To Tom Lee, it's just an overreaction. Not too much of a problem. Now, he does go on with a little bit more details, saying that the market is changing its tone around tariffs and taking them a bit more seriously.
Well, I think on the stock side, markets are now saying, look, the new regime is we have to take the tariffs seriously. Now we don't know how long these tariffs might be. Will it hurt growth? And we've seen cuts from economists. But the bond market is saying, well, you know what? This is a growth scare. But the Fed is also now in a position to begin cutting because inflation pressures are abating.
He is correct in saying that the market today is now concerned about those rumors of recession fears. If we get into next earnings season and companies have lowered earning estimates, you'll have revisions in earnings going forward. And any type of downward revision to the market will mean that recession territory is more likely, investors become concerned, and stocks will trade at lower multiples. So part of that is the nervousness going into next earnings season. So even though Tom Lee believes that this is an overreaction, he still notes that there's a lot of uncertainty, and it makes sense for investors to be a little bit cautious today. Over time, the uncertainty will clear. It always does. But right now, investors are having to concern about that. And as far as what I'm doing in this downturn, I have not done any selling. So I've sold no shares of any of the companies so far during the downturn. And I've also started to do some buying. Yesterday, I bought $5,000 more of Amazon in the Story Fund. And I also just today bought $5,000 of Google. Now, we also get to the news that Salesforce is pledging to invest $1 billion in Singapore over 5 years in an AI push. Salesforce is expanding its AI effort, and it's leading the way with Agentforce. This is their now key product. It's the thing that they're revolving their whole company around. It's already grown a lot in sales, hundreds of percentages over the past year, although it's relatively new. And right now it still makes up a small portion of Salesforce's total revenue. But Agentforce has a lot of growth potential. And Mark Benioff is very outspoken on how he views AI and which companies he thinks will benefit and which ones he thinks are commodities. And in a recent interview, he takes a lot of shots at big tech, specifically the hyperscalers, the cloud computing companies. He doesn't think these companies are unique at all. He doesn't believe the products that they offer are unique at all. He believes that what Salesforce is doing is unique.
The way to look at that is we've all heard about these multi-$100 billion data center
CapEx
investments every week. There's another multi-$100 billion data center investment happening, and we have not been doing that. We're a software company, so we're all about building that software over the last 26 years to run on those data centers, and we've just never seen prices this low for deployment because it is a huge level of investment, and when you get this huge level of investment, it drops prices. And that means that for us, we're able to run and deploy at a very low cost, and it's a commodity product. You know, data center against the data center against the data center, a chipset against the chipset against the chipset. These are fundamental, commodities. So whether we're running on Alibaba in China or Amazon or Google or maybe somebody else in the future, these are just commodity centers. And the prices have never been lower. So you have this opportunity to take advantage of companies who are competing with each other to be the next generation hyperscaler. For our perspective, we want to be the software hyperscaler. We want to run across all of them and offer the lowest price for our customers and make it the easiest for deployment and to guarantee their success.
So he just called Alibaba Cloud, Google, Amazon commodities. And all of these companies are just pouring money into CapEx and they're getting low returns. The companies are putting this money in, and these companies aren't going to make a lot of money because they're just lowering prices. They're commodities. And now he's asked about this big question that the market has of whether or not all this spend into CapEx is really worth it.
Do they need to be spending hundreds of billions of dollars, the Metas and the Googles and the Microsofts and OpenAIs of the world, on these chips and data centers?
Well, I think that there's two schools of thought. I think there's a hypnosis that they think they need it because of the level of training. But I think that what you just saw with DeepSeek and also with Alibaba with their Quen model is that you don't need this kind of technology. So I think it has to be rethought. Exactly what are you doing and why are you doing this? Because you can get into a group think in technology also. And this idea, do they need it? Well, maybe they do, but also maybe they do not.
Okay, so he makes a lot of claims there. The first claim he makes is that all the hyperscaler products are commoditized. You have Amazon Web Services, Google Cloud, and presumably Microsoft Azure. He also named off Alibaba Cloud. So he's trying to paint the picture that these are just run-of-the-mill companies, that they're all commoditized. In reality, if he tried to keep going with that list of naming off more and more commoditized companies, the list ends right there. He would name off Microsoft and it would be done. Those are all the companies that are offering these type of services. You can try to find other ones. What other company can you go to scale your entire business on with cloud hosting? Huge Fortune 500 businesses. What other companies in the world are investing hundreds of billions of dollars into CapEx outside of these few companies? Which ones in Europe are doing them? I can answer that for you. None of them. There's not a single company in Europe investing hundreds of billions of dollars into CapEx like Amazon, Google, Microsoft are. So if they're so commoditized means that there's lots of companies doing the same thing. Like a restaurant, you can find thousands of them. These companies are unique. There's only a handful of them doing this. They don't exist in Canada. They don't exist in Mexico. They don't exist in Europe. They're not in India. They're not in South Korea. They're in the United States, and some of them now in China. There's very few companies doing this level of investment with this level of technology able to support the world's infrastructure. So I don't view these companies as a commodity. Another point that I'd bring up on the topic of these companies being commoditized is if you just look at the returns, typically the returns on a commoditized product start to have margins go down. They go down because everybody can offer the same thing. But if we look at the margins of companies like Google Cloud, like Amazon and Microsoft, they've only gone up over the past 5 years as they spent an increasing amount on CapEx. Look at the return on capital employed. Google's is going up. Look at the gross margins. It's inching upwards. Look at the operating margins. Again, inching upwards. The profit margins going upwards over the past 3 years as they've accelerated spend on CapEx. And you can see the same type of thing in all these other cloud companies. So I disagree with Mark Benioff that these companies are simply commoditized, but I do agree with him that they need to look carefully at the spend they're doing on this CapEx. In fact, we have Sundar Pichai, the CEO of Google, tweeting out that they have Gemma 3, a new AI model that is extraordinarily powerful and, even more importantly, extremely efficient. For example, this is an open source model that Google's making. So it's not their proprietary, closed sourced, most powerful model. Google has models that beat DeepSeek R1. So they've already benchmarked above that. But this is an open source one. And if we look at the image here, the important thing is that this thing can run on a single NVIDIA H100 GPU. Just one of them. Where comparatively, to run DeepSeek, you need dozens and dozens and dozens. So it's nearly as fast as DeepSeek R1, but it's like dozens of times more efficient. And this is the direction that technology goes. So Benioff is accurate in saying that this is getting a lot more efficient and the company's spending dramatically on all this CapEx eventually likely won't need to. Even though AI is a huge field, we're going to have more efficiency in AI, lowering CapEx spend, which I think ultimately is a good thing for these companies. If they can pare back on their CapEx, if they can run things more efficiently, I think that's better for the shareholder. Now, finally, as we've seen, we have a big warning from Ray Dalio. He's out with another big warning about what's going to screw up the US economy this time. And this warning is centered around shocking developments, or at least what could lead to shocking developments, which is the mounting US debt problem. I've been concerned about the debt as well, so we can look at what Ray Dalio says here. The first thing is the debt issue. We have a very severe supply-demand problem. The US deficit needs to go from the projected 7.2% of gross domestic product down to about 3%, Dalio said. That's a big deal. You're going to see shocking developments in terms of how that's going to be dealt with. So like we've discussed earlier with Brad Gerstner, cutting expenses, bringing down the debt is an adjustment period. And Ray Dalio is pointing this out as well. And right here, I think he's correct. But there's also some context with Ray Dalio. Every time I see these warnings about him, every single time, I just remember that he warned about something else, seemingly just a bit ago. In fact, it's been a pattern as long as I can remember. For over 10 years now, I remember warning after warning after warning from Ray Dalio. Let's go ahead and just take a look at some examples here. This one goes back to 2018. Ray Dalio sees parallels to 1930s in today's market. That's a bit scary, but that was a warning he gave back in November 19th of 2018. Now we can fast forward from 2018 to 2021. Why billionaire Ray Dalio thinks another economic disaster is coming and how he recommends preparing for it. We have another huge headline grabbing a lot of attention from one of the most notable investors in the world, Ray Dalio. We can fast forward just a month later. Ray Dalio says that American decline will upend lives, not just your portfolios. In this very favorable write-up to Ray Dalio, it has quotes like this: "He's a big thinker and a brilliant academic disguised as an investment manager. These are the type of phrases that you want printed about you in different magazines. We skip through a couple of years of more and more warnings. We get to 2023. Ray Dalio says the debt ceiling debate sets the stage for a disastrous financial collapse. Again, that was May of 2023, so a couple years ago. We didn't have any disastrous financial collapse then, but that didn't stop him from giving further warnings. June 8th of 2023, billionaire investor Ray Dalio says the US is at the start of a debt crisis and worse times are ahead for the economy. And this is where his warnings have now shifted into the debt crisis, saying that the US is facing a heart attack within 3 years. You may look at this and see these warnings in earnest from Ray Dalio, just an honest attempt to help out investors. But I look a little bit further and I see that Ray Dalio has such a history of warning investors for so long that in many cases, if investors had listened to him at any point in time, they'd be much worse off today than they would have if they just listened to Warren Buffett and invest their money in the S&P 500. In fact, Ray Dalio is an investment manager that made his career early on by predicting disaster. He got a call right. He got a lot of notoriety about that call, a lot of popularity, and it launched his career into the stratosphere as a fund manager. Ever since then, he has been looked at as someone that gives these big warnings. And now he's looking for another thing to happen. He needs something to happen. He wants another event to happen that he can commentate on, that he can opine on, that he can descend from the heavens and give us his thoughts on how he knew it was going to happen, how he predicted it, and here's how everything's going to work. You can see with these constant warnings, he is waiting anxiously for something to happen. Now, if we look at his performance over the past 5 to 10 years, Ray Dalio's Bridgewater has underperformed the market by a dramatic extent. We have write-ups by people that have done analysis on his performance, saying the unsurprising failure of the largest hedge fund in the world. When they look at an analysis of his performance, they say that calling it a subpar performance is an understatement. This is abysmal performance. Bridgewater used a strategy called risk parity, which is a more complex version of investing to protect your gains. And the benchmark for it is the 60-40 stock bond mix, which is very much a classic in investment management. Bridgewater and other hedge funds that practice risk parity, according to hedge fund research, had appallingly bad investment performance relative to that benchmark. The numbers in the Bloomberg article show that for the 10 years from 2014 to 2023, an investment in a simple 60-40 portfolio would have enjoyed more than twice the gains of an investment in the risk parity portfolio. The 10-year return of Bridgewater's all-weather fund was 43%, and the 10-year return of the average risk parity fund was 42%. Meanwhile, the 10-year return of a 60-40 portfolio was 90%. So the institutional investors in the Bridgewater portfolio have had 10 years of incredibly bad performance, all the while waiting for something dramatic to happen. And their main public spokesperson, Ray Dalio, is out and about predicting it once again, trying to keep investors' money in his fund. Should we listen to him? Maybe his prediction will come true this time, but based on history, he's always predicting something bad will happen. That's all for now. See you in the next one.